Today is property springing into life or catching a cold. Hello again, it's Martin North from Digital Finance Analytics. Well, I've noticed posts covering finance and property news. Whilst data should be immutable, interpretation of said data can be tweaked and turned to spin a particular story. As we've seen in the press this past week, take for example auction clearance results. The preliminary auction clearance results for this past weekend in the biggest markets of Sydney and Melbourne came out tracking nationally at 71.4% of homes listed for auction. That's based on CoreLogic's data. Sydney's clearance rate was 74.9% and Melbourne's 68.7%, more or less in line with last week. Among the smaller capitals, Adelaide led the way with a clearance rate of 79.5%, followed by Brisbane at 67.3% and Canberra at 56.5%, again according to CoreLogic's preliminary data. But those are on very low counts, so perhaps they're not that meaningful. Domain, on the other hand, reported a Sydney clearance of 67.8%, up from 64.2% last week and below the 68.7% from a year ago. Melbourne was at 62.4% compared with 59.6% last week and 61.9% a year back, and the national number was 63.5%. That's a significant divergence from CoreLogic's higher 71.4%. Now, there are a few points worth making here. The final numbers tend to settle lower because agents are always keen to promote successful sales, while those passed in are either never reported or reported later. Some properties are withdrawn before auction, either because they were sold prior or because the vendor changes tack. As such, auction clearance rates really don't tell us much at all, but of course, often are reported in the media pretty much every week. And of course, the spring selling season is now ramping up, with around 2,300 auctions scheduled in the coming week. That's compared with around 2,000 this past couple of weeks. And listings are rising as vendors decide to sell or indeed are forced to sell. Now, we're going to chat about this again on Monday's Rant with Edwin, but we do continue to see a spate of ex-investment properties listing, especially in Melbourne, as I reported recently, and the trend is widening. As reported in the AFR, CoreLogic's research director Tim Lawless said, with the flow of fresh listings, including auctions trending higher, the depth of market demand will be tested over the coming weeks and months. Too right about that. And with weakening appetite on the demand side, as would-be buyers grapple with the higher cost of borrowing, clearance rates are likely to fall, putting further pressure on prices in Sydney and Melbourne. That's according to SQM research founder Louis Christopher. It's likely auction clearance rates are going to fall from here in Sydney and Melbourne. That's going to then equate to price falls in Sydney and Melbourne for the remainder of the year, he told the AFR. That all sounds like doom and gloom, but what it represents potentially, though, on the flip side, is a window of opportunity for buyers. Well, we're going to discuss that later. SQM Research is not expecting in any way this is going to turn into a housing crash. It's a modest to moderate downturn, and it will come to an end fairly quickly once we start cutting interest rates. He went on to say, I do believe housing prices are falling in Sydney and Melbourne as we speak. The magnitude of declines on an annualised basis represents somewhere between 3 and 5% for both cities. Now, another factor, of course, is that although the Fed is almost certainly going to cut rates in September, the outlook in Australia is for rates to stay higher for longer. Although, as discussed yesterday, CBA is cutting the rate on new home loans for some new customers. As part of our ongoing review of our interest rates and market conditions, we have today reduced the interest rates across some of our fixed and variable home loan products for new borrowings, a CBA spokeswoman said. Deposit rates, by the way, have already turned down as banks seek to create more firepower into the spring season for property transactions. And Domain's recent profit and loss report showed that the proportion of profitable house sales ballooned across the country, rising to 96%. the highest level in 16 years, while the share of units selling for a profit jumped to a 13-year high of 90.7%. And they went on to say house sellers nationwide pocketed, on average, $326,000 gross profit in the past financial year, the largest windfall on record, bolstered by robust increases in values despite higher interest rates. But of course, this is pretty meaningless given the large run-up in prices in recent years and the fact that many who are selling have held the property for many, many years. Nicola Powell, Domain's Chief of Research and Economics, said most of those houses were likely purchased before the pandemic boom and were held over a long period of time. It's quite a surprise to see Melbourne achieving those profits, considering their recent weakness, Dr. Powell said, but for owners who bought 10 years ago, their houses would have increased in value significantly. These results show that homeowners are walking away with large profits selling their houses, cementing property as a reliable and highly desirable means of building financial wealth and security. Well, it sort of begs the question, why are they selling now? Well, from our surveys, we see quite a few down traders releasing equity, including the opportunity to top up superannuation, and the average time they held the property was 8.9 years. Those trading up are also active because they need to move for work or looking for a bigger place. The average hold time for those is 5.2 years. On the other hand, we see a rise in people who bought for the first time in the period directly after COVID and who are now experiencing significant mortgage pressures. Some are getting out, releasing equity to repay the bank and moving on. Average hold times for those are less than 2 years. And we also see some, though, who bought high-rise units in some areas like North Ryde in Sydney, who've also thrown in the towel, having seen no capital appreciation in the past 5 years. Indeed, most of those were property investors who are really actively selling now with an average hold time of 5.6 years, and which may offer another investor or a first-time buyer a chance, though frankly many coming on the market at the moment are property dogs, not property stars. Many with quality properties are just not wanting to sell. But note that some first-time buyers are jumping in and making bad purchasing decisions, that I discussed with Veronica Morgan recently in a live show where we looked at real case studies. My point is, of course, you cannot generalize about property. The individual submarkets are behaving very differently, and those making Amotsa reports actually deceive. Still, Domain remains bullish, with Powell saying if the cash rate is cut early next year, that could spark greater momentum back into our housing markets, although I think we need to see multiple rate cuts before we see that sentiment improve. I think this time next year, we could see further increases in profitable sales in most capital cities, as we're still expecting prices to rise, although at a slower pace, and would vary nationwide, she said. The bottom line, of course, is that potential buyers should be careful what they purchase, especially as price growth ahead is not assured, especially if the weaker demand for iron ore puts the economy into recession and migration eases back. And prospective sellers would do well to select their agents carefully, as some are still pushing the auction route, one which does not necessarily guarantee a better net sale price, but does guarantee more income for agents via their additional marketing and auction fees. Just saying. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Brisbane Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.